So tell me right now, the 10-year, where's the low, Sri?
The low for the stock market, I think, is quite a bit below where we are. I think before the coronavirus has its full impact, I see the Dow is just below 26,000. I wouldn't be surprised to see it go down another 10 to 15% from current levels. And I've long been telling you, Oliver, that the 10-year yield is headed down and not up. And now that we hit 1%, which was my target before, I'm now looking at the 10-year at 75 basis points. So we are more of a rally in U.S. Treasuries ahead and more of a correction in equities ahead.
Are bonds truly saying that this is recession at this point, Sri, or is this just more of expectations or speculation, rather, that we're going to have cuts and more monetary stimulus?
I think what it is showing is that there is a recession ahead. Clearly, the monetary stimulus is one factor, Oliver. So if you said if there had not been a monetary stimulus, would the 10-year have been somewhat higher? Perhaps. But the 10-year is essentially a reflection of inflationary expectations and your expected real growth. You want to, as a holder of bonds, you want to be compensated for the real rate of return, and you want to be compensated for the loss of your purchasing power due to inflation, and both of those are the essential components of a 10-year yield. On top of that, you throw in a global uncertainty, which is an intangible on top of it, and that's what this coronavirus turned out to be. The point I make is the other two factors, growth and inflation, were already pointing to a lower Treasury yield. So that, I think, is what you want to look for long term. I'm looking for the U.S. recession to begin mid-year. That's something I've been saying for quite some time. And the coronavirus just makes me even more even more in the path of expecting the recession to begin in a few months.
Sri, if the bond market right now is pricing in this recession, it seems to be, I mean, we're looking at the charts, right? It's no mystery what this is about. It's about coronavirus. But we don't know. We've got no precedent for this thing. We have no idea what the implications are. We can say it's probably not going to be good. But right now, I was just talking about some of the chip makers whose guidance is still in line, if not slightly worse than what they said a month ago. So if China's already bottomed out its economic impact, what if bonds have this wrong, Sri? What if we were at a moment where fear has gotten too far, and fear is the bubble here that we have to be worried about?
Oliver, all of those are good questions. I'm going to answer you in several parts.
Okay.
First, the bond market predicted correctly the last two recessions, the short recession of 2001 and the Great Recession of 2007 to 2009. In October of 2007, when the bond market yield curve had already inverted and we were talking about a recession to follow, and I did a report saying we were at the verge of a recession. This was late 2007. About that time, the equity markets that month reached a record high. S&P 500 record high was in October 2007. So the first point I make is the stock market is a bad indicator of the economic cycle, and the bond market has been a better predictor.
Sri, if I can jump in real quick there, because I think this is crucial. I know you've got other parts to this, but this is crucial because I'll argue the other side for a sec and say that in early 2018, bond market was selling off. Bond market thought synchronized growth. Bond market was watching Davos and everybody's saying we're about to have synchronized beautiful growth. Stock market cyclicals and semiconductors then got slammed for 6 months. I would wager stocks got it right there post-February 2018, and it took until October for bonds to get it right.
Well, in terms of the equity market getting it right, the equity market has generally been on a bullish trend for the last several years, Oliver. So in other words, if you're trying to take a cue from the equity market, you wouldn't have had any recession at all going back to the 1990s. The point here is I'm not telling you that the bond market is perfect. I'm saying that there are other storm clouds, and before the other storm clouds came out, you had the 3-month to 10-year yield curve invert. You had the 2-year to 10-year invert as well. And we found out from both of the last two recessions that before the recession begins, the yield curve starts to steepen. And that quality was again found in both these cases. But you did not get a recession signal from equities. I'm not trying to say to you that bond market is always perfect and it is telling you which way it's going to go, but it is more likely than not to be telling you about a downturn which you do not get from the equity side.
What do you make of the rally in bonds that we've had since the cut? I mean, this did happen after the Fed pivoted in 2019 up until bonds peaked out in September. So bonds didn't continue their rally after the late fall cut last year. But to see bonds keep surging after Jay Powell made this measure, does it mean that we should expect more cuts? Are we in this kind of virtuous cycle where bonds push the Fed to cut, the Fed cuts, bonds rally more for more cuts? I mean, how does that resolve itself, Sri, if bond markets can know by virtue of their own actions what's to come that then makes it even a more bullish trade?
Yeah, the difference with the rate cut that took place earlier this week is that it is, again, by character, it was very different from the previous rate cuts, the three rate cuts that took place in 2019. 2019 was bad enough because, remember, late December of 2018, Jerome Powell told us he was going to raise rates another 3 times in 2019, only to pivot 2 weeks later. So the chairman gets a low grade as far as credibility is concerned and consistency and sticking to what he said. What happened in this most recent case this week is that he said he was cutting by 50 basis points. At the same time, at the press conference, he told us he doesn't think it would be very effective. So this was a great case of undercutting your own message. And it leads me to believe that it's almost like saying, well, I couldn't bear the brunt of the presidential tweets attacking me, so I have since decided to cut rates. But hey, guys, look at me. I don't really believe it's going to work.
Yeah.
The combination of all that explains the rapidity with which the 10-year yield plunged, and within a few minutes, going from just above 1% to just about 90 basis points. That was a big decline. And that couldn't have happened not just with the Fed action, but the Powell statement.
You had a tweet, Sri, that was right in line. I wrote this week that it was the funeral. I wrote the eulogy for the dual mandate on Forbes, saying that after 100x years or whatever, it's dead. It seems like you agree. You say monetary easing to support stock market has been crux of Federal Reserve post-2008. This one was no exception. Needs repeated reminder that their mandate is economy and inflation, not to make speculative bubble bigger. Do you believe that the Fed should be held accountable for the speed and the savagery of what we've seen in stocks over the last couple weeks? I mean, would we even be at this elevation if it weren't for the cuts in 2019?
Well, the Fed is responsible, and the Fed is responsible because there are a group of people sitting in Washington and at the Federal Reserve banks at the different centers who make discretionary decisions on interest rates. And the rates are not always correct. In fact, more likely than wrong, than otherwise they are wrong. It would be much better to let the money growth and interest rates follow a set policy, such as the Taylor rule, for example, and take the human hands off the decision-making mechanism. So to the extent that is not done, I would say that the Fed is responsible for a good part of the economic cycles. They cause recessions when they increase interest rates when it is unwarranted. And after the 2008 crisis, they kept the problems going with a low growth rate in the last 11 years because essentially the savers got no return from the zero interest rate. We are going back to the same situation. We are going to perpetuate it, and the Fed is responsible. I don't see any way to escape the conclusion, Oliver.
Sri, when you look at the options for why they're doing what they're doing, to your point, it's clearly not any change to the inflation front. If anything, inflation's been moving against them over the past year, as we've seen climbing CPI and PPI. It's not the employment situation, of course, which is good. So at your point, it's either the presidential tweets or some combination of that with the bond market action. So I want to come back to bonds before we let you go, because I think this remains the most important question. Stocks are in trouble right now. As you point out, you think there's more correction on the way, but bonds are really the vigorous move. Is it possible that if the Fed is cutting based on what the bond market is doing instead of their dual mandate, that we now have a self-fulfilling mechanism that puts bond prices vastly out of proportion with the actual economic risk? If coronavirus does not derail the global economy the way we hope, are there major ramifications of a bond bubble unwind?
Let's assume, again, going with your reasoning, Oliver, that the coronavirus crisis comes to an end very quickly.
Right.
Under that setup, you still are going to have the supply side impact that has taken place due to the coronavirus impact.
Okay.
And how the companies have to spend several more months in terms of getting back to normal shape. So what I would say is that 2020, therefore, is a washout. You can't save this year, even if coronavirus stops on its track tonight and there is no further spread of the illness. Now, on top of that, the Fed is probably going to cut interest rates further. They did 50 basis points. They'll probably cut another 50 basis points later this month at their regular meeting. They may then at some point resume quantitative easing or purchase of bonds. That will push bond yields even lower. And none of that is going to help very much with the economic recovery. The recovery will happen when it happens. So the answer to your question is that I don't think there is a case to make for misjudging where the bonds are headed, the same thing that I've been talking about for 3 years. It was very clear to me that the mismanagement by the Fed assures you of the bond yields continuing to go down. And even though we have reached a very low level, I think there is still some way to go.
So is the only potential shock then to the bond market some surprise fiscal outlay or some unexpected spending effort by the government to counteract this thing?
Well, if they are just going to spend it without making a targeted effort, Oliver, I don't think that is going to be effective in countering the monetary policy. What the government would have to do is to be specifically targeting small businesses to try to help them in order to provide cheap financing, not to everybody, but to the companies which are hiring workers to make sure that they can continue to operate. Instead, we have essentially a shotgun approach where we just cut interest rates and then sit down and pray and hope everything would be okay. That's not going to work. Or just increasing the deficit on the fiscal side and not targeting it towards specific sectors, that's not going to work either. You need specific target. You need more coronavirus research, all effort being put to find a cure quickly. This is a structural problem. It's a biological problem. You can't just fight it with fiscal expansion or with interest rate cutting or quantitative easing.